Good evening, everyone, and welcome to the 28th session of the AIM Prime program. Today's session is on essentials of company structure and finance. And our speaker for today is Sujata Bogawat. Sujata engages with startup funded startups in the domains like fintech, deep tech, science-based, SaaS, e-commerce, and startup incubators. Providing strategic as well as hands-on advice at the same time, giving an outside-in perspective on the business is at the core of her role of a virtual CFO. As a founding director of Pune's first startup consulting firm, Avantage Business Consulting, Sujata leads a team which provides reliable and proactive services in investment, advisory, equity structuring, business valuation, Esop, cross-border structuring, and overall financial management of startups. She is strongly connected to startup incubators across India and serves on their investment committees in honorary capacity. She was also the founding program leader of Startup Leadership's Pune chapter and led it for 3 years. Sujata is an active angel investor, a startup mentor, and a speaker on subjects of startups, startup finance, business evaluation, Esop, etc. Some of her earlier stints include working with India's largest online ticketing platform, which got acquired by BookMyShow, an IoT startup in the mobility space, acquired by Varroc Engineering Limited, a listed auto OEM manufacturer. She has also worked with multiple offshore IT development companies acquired by US-based IT conglomerates. Sujata was also part of CSIR Tech Limited, a company affiliated to the CSIR, which was formed to commercialize technologies developed by its 37 national labs. Previously, Sujata has worked as a vice president finance at firstcry.com. She was also general manager at Venture Center and finance controller at Thermax. With this introduction of Sujata, welcoming her to the session, and over to you, Sujata.
Thanks, Mukta. Am I audible?
Yeah, you are.
Okay, I'll share my screen. Can you see my screen?
Yeah.
Okay. So should we begin?
Yeah, we can begin.
Okay. So good evening, everyone. It's my pleasure to speak at the AIM Prime program. I'm going to talk about a couple of things related to finance, legal, accounting, financial management, overall stuff, as well as some aspects of investments, term sheets, etc. over the next 8-10 days. But how do I put it? Okay, I mean, let's face it, right? Finance, legal, accounting stuff is really not the most glamorous part of being a startup founder. In fact, the startup mechanics of the financial mechanics rather of running a startup can be either really boring or very overwhelming. And so it gets delegated to CAs like us or accountants. And it's also evident from the AIM Prime schedule that it's being left right towards the end, right? So, but what happens, seriously, is that founders learn about legal intricacies and the financial management of a business on the job by way of trial and error. And though it can be argued that learning from making errors is a part of evolution of a startup, some outcomes of financial decisions cannot be undone. Over the last decade, I have worked with dozens of startup founders focusing on deep tech science-based ideas specifically, which a large number of those startups are also grant funded. So in my session today, I will endeavor to share with you some aspects about startups, which I wish the founders would have known early on, and the critical lessons I have seen them learn the hard way. A quick note before I jump into the session is I have planned three question and answer sessions, one towards the middle, other towards the end, and the last one right towards the end. So feel free to keep sending in your questions as you think of them in the chat box, and we will take them up during the times that I have planned for Q&A, right? So what what's the agenda for today? What have I scheduled for today? Right. I'm going to speak about three aspects of these three basic topics. Okay. I understand the participants in this program come from different backgrounds and are at different stages of their startup journey, and so it's very tough to design a talk to address such a diverse group. So bear with me in case you find some of the content very basic. My hope is that even if you're aware of some of the topics, you will gain a different perspective or a deeper insight in them, right? First things first, I cannot emphasize that choosing the wrong entity and ownership structure can be very costly or even catastrophic to a startup, because it's very difficult to course correct once you've chosen a particular path. In India, you have these different options. Okay, when you go set off to start a company, a private limited company, a limited liability partnership, a one-person company. If you're in the social space, you could also set up a society, a trust, or a Section 25 company. And there are also other very traditional kind of entities, which are partnership firms and sole proprietorship firms. But the key aspects to consider when you are deciding which nature of an entity you want to incorporate is, firstly, are you looking for investment funding? If yes, private limited is the only way to go. Investors do not invest in any other type of entity. Do you want to give stock options to your employees? If yes, that can be done only in a private limited company. However, if you're not thinking of raising an investment, then you have more options. The decision then should be driven by whether you're going to have partners and what kind of liabilities do you expect in your business. If you're in a consulting business, like mine, right, for example, where my liability is restricted only to the fee I charge, I have no partners, and so nobody else is taking any business decisions. I'm the only one who's taking the business decisions. Then I could even set up a sole proprietorship firm. Okay. However, if you're entering a risky business, or you have managers, or you have partners taking business decisions, then an LLP is better. And that's better because in an LLP, you can restrict the liability, and personal risk. In a sole proprietorship, there is no difference between you as an individual and your business. And so any liabilities that you take on in the business can be passed on to your personal assets. But in an LLP, you could restrict your liability only to the extent of your capital or the role that you're playing or the decisions you're taking. Any risks, occurring on account of your partner's decisions or your business manager's decisions may not be directly, personally, may not impact you as much. Okay? Lastly, you may have other considerations such as customer perception. Large corporations will only work with private limited companies, or you're looking for CSR funding, which can be secured only by not-for-profits, or income tax rates for private limited companies are lower than that for LLP. So if you're looking at a highly profitable business, then a private limited company might make more sense, even if it's a consulting firm. Or if you're simply trying out an idea and need a business entity for a few months, just like a short term where you're trying to do different MVP, or you're trying to do your research and you need a business name, in that case, even a sole proprietorship might be okay. Now, it's very crucial to think about these aspects and zero in on the entity type early on. I see many founders make the mistake of starting an LLP because they have been told that. Can somebody tell me what you have been told? Has anybody over here started an LLP?
Less compliance.
Less compliance. Yes, you hit it on the head. You hit the nail on the head, right? I see many founders make that mistake of starting an LLP because they have been told that the cost of compliance of a private limited company is very high as compared to an LLP, and then you go and start an LLP. But let me assure you that given the way LLP regulations are being made more and more stringent, the cost of compliance is only marginally higher. You've also been probably told that at any point in time, you can convert that LLP into a private limited company, which is yes, which is right, you could. But do you know that the process of converting an LLP into a private limited company costs you twice as much as setting up a fresh private limited company? Because you have to apply for a name, you have to register a private limited company, you have to get new business registrations, and then you have to surrender the old business registrations of your LLP and move your business from the LLP to the private limited company. It is not a small deal. So in case you're very certain that you are going to need investment funding, you want to give stock options to your employees, then remember, start off with a private limited company. But in India, there's also one more major issue, and which is it's not easy to shut down an entity. You need to close bank accounts. You need to cancel business registrations like your PAN, TAN, GST, shop pack, profession tax, etc., etc. And in the case of a private limited company or an LLP, you might even need to show that the NLP was, or the private limited company was dormant for 2 years. So once you've decided to set up shop, instead of heading for the cheapest online incorporation website, please go to your advisors for you, because undoing this decision or redoing it again is going to be more costly. Okay. The next question that I get from a lot of startups is, where should I register a company? Okay. Now, this question is actually split in two parts. Where should I register a company in India, and where should I register a company overseas if I want to, and whether I should register a company? So in India, it's very simple. It doesn't matter where you're staying. What matters is where in the long run is your business going to be run. If I'm staying in Pune today, but my market is in Bangalore, or my talent is in Bangalore, and eventually I'm going to go to Bangalore, then it makes sense to incorporate a company in Bangalore, because moving a company within the city, very easy. All you need to do is file one form and change addresses in all your business registrations. I mean, it is quite a bit of work, but it is still easy. Moving a company from one state to another state is a lot of hassles. It takes minimally 6 months. You have to give newspaper advertisements and notices and get NOCs from your creditors, etc., etc. It is a lot of work. And so don't have a very short-term perspective or short-term view on this. Think a little bit, and then you decide where in India to set up your company. Okay. Now, whether to register a company overseas is the next question I get. Now, and I don't know if you guys have heard of accelerator or programs such as Y Combinator, which basically insist that you have to incorporate your company in the US if you want to enroll or be a part of the Y Combinator cohort. Okay. And they also give you support, and they also subsidize the cost of registering a company overseas. But just because you're getting subsidized rates to incorporate overseas, should you? Okay, that depends on a few things which you really need to think about. Okay, this decision should be driven by 1, the nature of your business, 2, the location of your customers, 3, the intellectual property, 4th, remember, comes the investors, and most importantly, your budget. Okay, because in India you pay in rupees, in the US you pay in dollars, which is about 75 times more than 1 rupee. Right? Now, some years ago, it was a trend in a lot of VC-funded startups to flip overseas, because it was not possible for a loss-making startup to list in India. But the IPO regulations are changing, and the success of startups such as Zomato on the stock exchanges show that it is not a compelling reason to go overseas any longer. Okay. Now, when it comes to nature of your business, if you're an online platform where you can basically provide services digitally from India and collect money in different currencies via different payment gateway portals, you needn't go online. You can be registered in India. But if you're a biotech startup and your investors are worried about IP infringement, or suppose Boston-based investors appreciate and understand the value of your startup better, or it's easier to raise follow-on funding in the US, the round sizes are larger, etc., and you really see a lot of tangible benefit, then US is the place to be. A compelling reason to go overseas is also that the regulatory framework in the chosen business space might be more evolved. For example, in the case of cryptocurrencies or in the case of drones, right? Indian regulations are way far behind. There's a lot of uncertainty. So you're probably better off then incorporating in the US or even in Singapore. But remember that the cost of incorporating a company outside India is very, very high. And so it may be okay to register in India first, try out your MVP, raise some funding, and spread and diversify and go overseas only when you really need to. Of course, there's a flip side to it, which I will come to in a minute. But one caution when you're thinking of incorporating overseas is, other than costs, right? There's a lot, other than incorporation costs, there are a lot of tax and compliance costs involved, which can be quite tricky to navigate. Okay, compliances involve cross-border, in companies which involve cross-border transactions and holding, like, let's suppose you have an R&D company in India and an IP holding company in the US. Under the transfer pricing regulations of income tax, you need to set aside between 12 to 20% of the development cost being incurred in India as a transfer pricing markup. And you need to pay tax on it in India, right? Tax at 30%. And sorry, not 30%, 25%. And although on a consolidated or a group level, your startup may still be incurring losses, you may not have revenues in the US, you still have to pay taxes in India. So in case you are considering the structure of an IP holding company in the US and an R&D or development company in India, do remember to set aside 4 to 5% of your Indian costs as a tax write-off. Also, a couple of other rules to remember: in case the turnover of your startup exceeds 50 crores and you are managing a business incorporated in the US, but you're sitting in India, under the POEM rules, the profit of the overseas company can be taxed in India as well as in the overseas jurisdiction. And so at that point, you should definitely have a business manager in your overseas entity, no matter what the payroll and the recruitment and the visa cost. Okay. A misconception amongst, and this is very, very common, most founders think that it is possible to avoid tax by incorporating in certain tax havens or certain jurisdictions as Singapore, Mauritius, right? But please understand, it may not be the case. While the tax on business income is decided by the place of operations or the place of incorporation of your company, the tax on the capital gains that you pay as a founder at an exit event depends on your location. If you are sitting in India, your company is in Singapore, and you sell the shares of your Singapore company, you still pay tax in India, because it's your residence status, your residency status that really determines the tax. So if you're under the notion that in a corporate in Mauritius or incorporate in Singapore, I will not have to pay tax, please dispel that, right? One other, and I know that a large part of this cohort has companies which are working in the deep tech space. Remember that if you're a biotech, deep tech startup, and you hope to raise grant funding from the Indian government agencies or government supported incubators, or you're looking for equity funding from government grant funded incubators, you should be aware that startups with over 50% foreign shareholdings are ineligible to access the grants and equity funds. So if you do not, so if you do need to set up a parent entity in an overseas jurisdiction, you might want to ensure that you've exhausted all the source of Indian government grant funding before you decide to do the flip. And in case you have already raised equity funding from government funded startup incubators, you may not be able to flip overseas until and unless you have them off your cap table. Okay, this is something not many founders know, so please do remember that. One another commonly experienced question that I always get is startup founders who come to me and they tell me, Sujata, I want a holding company, a subsidiary company, a spin-off, a spin-out. I want to create different companies for different product with different partners in different geographies. One I do want to do for R&D consulting. Another I want to do for contract research. Another I want to do, I want a spin-off for a product that is based on a specifically in-house development, patent or technology. Lots of complex structures that will even put Reliance to shame, right? My recommendation is please don't do that. In the beginning, please make sure that you start only one company, see where it goes, have that company do the research, own the IP. This can be your holding company. And when investors do want to invest, when you do get partners, at that point, consider setting up entities on a need basis and only if it's really strictly required. Right? Because unless you have a high budget and a bandwidth for managing compliances of multiple entities, it's going to be very difficult. You'll probably end up missing on compliances. You'll end up paying through your nose for the administrative costs. And also remember, in most startups, the original plans change. Most startups pivot. Product ideas, business models keep changing. But if you set up an intricate web of corporate structures and holdings, set up too many entities right in the beginning, it will hinder pivoting at a later stage. So to sum up, my advice to early stage founders is don't opt for a complex web of entity structures. In the beginning, keep it simple. But do consider restructuring as soon as you have clarity on the business model and you can afford it.
Can I ask a question, Sujata? Couple of questions have come up on the box. So yeah, there's a question on whether what is the difference between a sole proprietorship firm and a one-person company?
Okay, sole proprietorship, okay, an OPC or a one-person company is a corporate version of a sole proprietorship. Like I said, in the case of a sole proprietorship, there is no distinction between the founder and the business. If you take on a liability and your business assets are not enough to pay for that liability, your personal assets can get attached. Did you know that other than your provident fund balance, every asset you own, be it your house, your retirement savings, your investments, your children's education funds, everything can be attached to pay for a liability in a sole proprietorship. But in an OPC, that's not the case. In an OPC, the liability is restricted, limited only to the assets of the one-person company. And so if your company does not have any adequate assets to cover the liability, you needn't pay from your own personal pocket unless you've committed a fraud, in which case all your assets other than PPF can be attached.
Yep. There's another question here. What is the process of registering an overseas division of an Indian company? Does it have to be a separate entity? division?
Okay, so yes, if you want to, a division necessarily means a vehicle through which you're doing some work, right? It could be business development. You could be hiring employees or contractors, getting orders from your customers, or selling products, whatever. For any of that, you will need to have a formal entity registered. It could be a subsidiary, it could be a parent company. Most commonly, if it's a division, then it is a subsidiary of the company.
So if there's an Indian company which is, say, having a marketing activity in the US, you're suggesting they could do it as just a marketing division of an Indian company, right? Rather than set it up as a independent entity?
See, a biz dev entity is typically to get contracts from customers, right?
Yeah.
And so if you're getting a contract from customers, then those contracts, the customers will prefer to have them in the name of a US based entity with a US address, and so it has to be a company.
Yeah. And especially in some of the service agreements or the agreements that you sign, they might insist on local laws applicability and so on and so forth, and
Yes.
therefore they might want the local company out there. Yeah, but in principle,
Yes.
I think if they are okay, it should be possible to, say, engage a person located in the US as a consultant and run a business operation. Is it? I mean, as a marketing operation.
It is possible. It is possible for the Indian company to engage a contractor in the US, pay them in US dollars. There might be some additional tax requirements in India, because if you want to pay from India, you'd have to deduct TDS at 10-20%, or depending on the double taxation avoidance agreement. But there's nothing that stops you from doing that.
Okay, there is a question on co-founders, equity, and all, which I think we'll wait.
I will touch upon that.
Yeah,
I will touch upon that in the next section.
Yeah, there's another question on NRIs investing in private limited company for
investments. I will take it up. In my next session on Monday.
Sure.
Coming Monday.
Okay, fine. Let's continue, please.
Sure. So once you've incorporated your company, what all do you need to know? What all do you need to do? A lot of you forget to do all of this, and then at due diligence, when you've got a term sheet and you've got a due diligence auditor asking you for this registration, that document, there's a big scurry and everybody's running around trying to put that in place. Okay, so a few things to know right in the beginning. The mandatory business registrations are mandatory. It does not matter whether you have any business or not. PAN, TAN, profession tax for the company, for the directors, getting a minimal shop act license, etc. All of this is mandatory. Please make sure you have that right in the beginning. Optional, yes, you can get your GST number, you can get your PF, ESIC number. These are all now allotted at the time of incorporation itself. You don't have a choice anymore. Get an IEC. The process has become very cumbersome in the last couple of months, but that is necessary. Make sure your Startup India registrations, recognitions are in place. There are 3 kinds of registrations in Startup India. One is the basic registration recognition, which almost all startups will get. Like 99% of all startups who apply for it will get it. Okay. The next is section 56262, which basically exempts the company from angel tax. That also, in my experience, most startups will get. There are some restrictions on the startups for obtaining this exemption, but please do get it. Keep it very simple. 80IC is the most difficult. I believe in India today, only a few hundred startups out of the lakhs who have applied who have got this 80IC, but that basically gives you income tax exemption. There might also be business-specific registrations like DSIR, factory license, if you're in food, and FSSAI, or health and safety-related ones, or pollution control board, NOCs, etc. You have to understand all of that and make sure that you get all these. One thing which I missed because this Zoom window covered it was the co-founder agreement. Co-founder agreement has to be done, especially if you are getting co-founders who are friends, ex-colleagues, people who are not your family members necessarily. Please make sure that you have a co-founder agreement executed and in place, that so that there's clarity on the roles and responsibilities of the team. Within the first few months, I'm just moving on to the statutory bit. Within the first few months of the incorporation, what's really mandatory is an auditor appointment for a company. You have to appoint an auditor within the first month. You also have to get what's called now as the Certificate of Commencement of Business, the CCOB. Unless you have the CCOB, in principle, you are not allowed to start operations. You cannot hire anybody, you cannot rent an office, you cannot get a customer order, you cannot buy equipment, you're not allowed to do any of this. What do you need to get a CCOB? You have to pay the subscription money into the bank account, upload it on the MCA website, and the MCA will give you a CCOB. Okay. One thing that most startups miss out is the IP assignment. A lot of us look for a company name, buy the domain, and then apply for the company. Now, unfortunately, the company domain is bought in my name, it's not in the company's name, and then we forget to transfer it. So any IP that you've purchased, any know-how you've created, any patents you've registered, which are essential for the business, please make sure that it is transferred, assigned to the business company, business entity. Any previous contracts that you may have had in your personal name, which you want to transfer, please make sure that those contracts are also re-executed with the company. Policies to manage the company should be thought through and documented. Obviously, you might call, you might think this is too sarkari, ke kyun likh ke rakhna hai, what's my HR policy and my finance policy. Trust me, if you get these nuts and bolts right in the early stages of a startup, they help you immensely in ensuring smooth operations as the startup's business scales. It also gives your team members an insight on how you're thinking through all these different processes. And so you don't have to teach each and every one of them. You hand them policy handbook, and hopefully they will follow all those documented processes. Okay. So this was basically the incorporation and post-incorporation bit. If you have any questions, I will take those questions first, and then I have a short case study kind of things. We'll just run through those different scenarios, and I would love to get a lot more interaction from everyone in the session. Right. Premnath, are there any questions?
Yeah, Sujata, there's a question on, can you elaborate on finance and HR policies? Like what exactly do they have and what are they for? What purpose do they serve in the beginning? Yeah.
Okay. Let me take the HR policy first. HR policy should minimally have a leave policy. How many leaves are employees eligible to? What is their probation period? Have a code of conduct for them. Not necessarily rules and regulations like you'll find in a large company, but a basic code of conduct. What are attendance timings? When should you come? When should you leave? How to interact with your customers, colleagues, etc. You might want to also have your holiday calendar. One HR policy that is now mandatory for all companies, if you have more than 5 employees, is the POSH policy, prevention of sexual harassment at workplace, mandatory if you have more than 5 employees. There are some other policies which are also governed by laws, such as the maternity leave policy, the equal wages policy. Equal wages policy says that if you have women and men in your company, you cannot discriminate between paying while paying to them. So lots and lots of different regulations which govern the HR aspect of your business. All of those do need to be covered in your HR policy. Again, minimally, POSH, maternity leave, office timings, attendance, code of conduct, probation, disciplinary issues. Please make sure all of that is covered. And again, these policies are not cast in stone. As your startup evolves, as the team size grows, you will need to keep changing it. So that was HR. Finance policies, Especially if you're raising government funding, grant funding, you may need to look at GFR, government financial rules. You may be subject to tendering rules. You may need to have uh, certain templates and processes to follow, like getting 3 quotations, doing L1, L2, L3 kind of work, making sure that advances are deducted, TDS, wherever TDS is applicable, it's deducted. Now there are more and more stringent compliances, right? From 1st of July, there's a new rule in TDS which says that every vendor of yours should be asked whether they've filed income tax return for the last 2 years, and if their aggregate TDS is more than 50,000, etc. And if it is not, then you have to deduct TDS at 20%. You have to get their PAN numbers, all sorts of all sorts of restrictions, expectations from you in terms of compliances. So your finance policy should include all of that. You may also want to set up templates like travel reimbursement, reimbursement expenses related schedules where your employees can give you claims. Making tables and charts for yourself to manage all the expenses of your company, plugging it in a spreadsheet so that it becomes easy for your accountant. So all of this forms a part. I hope that was comprehensive.
Yeah. And Sujata, I think also authorization matrices and flows.
Absolutely. Absolutely. Workflows throughout the company, who's authorized to purchase, spend, on what kind of things, up to what limits, who's allowed to sign checks, who's allowed to sign purchase orders, up to what amount in petty cash can you spend. All of that is covered in the finance policy.
Yeah. Is there a requirement for some raising the first invoice within a stipulated period?
Yes. If you are registered under GST, then the first invoice, rather an invoice, needs to be raised within 30 days of provision of the service. If you're not registered under GST, you have some flexibility.
Yeah. Regarding company structures also, are there any companies which are leveraging, say, a cooperative model also? And how does that work out legally? Like suppose there is a, Amul like cooperative involved along with a private company. How does that work, and how should one structure such arrangements?
See, cooperative kind of entities are mostly for not-for-profits or with, the people come together with a not-for-profit motive. You could set up a trust or a society. In India, a society, even if you set up a society, it has to be registered as a trust. And you could also set up a trust. Your trust or society, if it is for charitable nature, if it is for a not-for-profit cause, then you have to register it with the Commissioner of Charities as well. If not, if you're okay paying taxes, it can be a private trust not registered with the charitable commissioner, where people are coming together only for the benefit of that group, like a housing society, for example, right? All the residents are members of the society. They pool in resources. They make sure that the housing society is well maintained. And they select a few of the residents as committee members, and they are given the fiduciary responsibility of managing those funds. That's how all cooperatives work. But primarily, they come from a not-for-profit perspective. And in which case, if you really want to set up something for not-for-profit, I would urge founders to look at Section 8 rather than a trust or cooperative society, because it gives you more access to funds. Also, it sets the credibility of Section 8 companies is, the perception is that the credibility is much better because you have directors and you don't have trustees, and the accounts are audited and they're uploaded to MCA, so the data is publicly available. So it makes sense to set up a Section 8 company rather than to go for a society or a trust.
Sujata, some startups, in the social entrepreneurship space have tried to use hybrid models of a for-profit and a not-for-profit. you want to comment on what are the issues in that? By the way, tell me when you want to continue, and I'll stop the
I would
questions.
like to. I kept only 5 minutes for
Go
Q&A.
ahead, yeah.
So why don't I go ahead, and if there are any questions, we have time towards the end, we can always take them up.
Yeah.
Yeah. Okay. So I'm going to ask you questions. I'm going to set out scenarios, and I would like the participants to tell me which entity would be the most suitable. Okay. So for a low cost medical diagnostic product serving rural populations, can you tell me which entity and where should we set up? In India or overseas?
On the chat box.
In the chat box, yes, please. Okay,
So far we have
answers from Sai Prasad, Sumit, Nikhil, everybody saying private limited company in India. Yes, that's right. If you're serving the rural Indian population, your customers are in India, then it makes sense to set up a medical diagnostic private limited company. Okay, next, a fintech startup dealing in cryptocurrencies. Any thoughts?
Yeah, I think we should have some good answers there because we have somebody from NSE background or BSc background. So let's hear that out also. So far, it's private limited overseas, USA, and so on, offshore company. Let's see.
Yep.
US private limited company. The Adish says overseas.
Okay. Would you guys like to take a shot at where overseas, in which country specifically?
USA,
yes.
Singapore.
Okay, so contrary to the answers, the sure, El Salvador. Singapore is turning out to be the place to go for cryptocurrencies. The central bank is very, very open to adopting cryptocurrencies, and they've already formulated regulations around it, and they aim to be the top, the best country to go to as far as cryptocurrencies are concerned. So Singapore and in the overseas is the correct question, rather the correct answer. Why not in India? Because we don't know what the regulations are. There are no regulations have been framed, and the early startups, the early cryptocurrency trading exchanges in India, remember last year they had to shut down for an entire year because RBI basically banned it, and then the Supreme Court came and overruled it, and so there's a lot of uncertainty. Makes sense to be overseas for now. Okay, the next one is an organization providing niche services for large overseas enterprise customers, and they're required to make visits for implementing those services. So
you mean client visits, like
client visits?
To visit, yeah.
Yes.
Client sites, yeah.
This on-site presence is required. Okay, somebody's saying JV, not necessarily. Private limited in India, Singapore, overseas private limited. Anyone else? Okay, so the answer is mixed over here. So there is no right answer. Okay, this was a trick question. You could incorporate in India and make visits to your customers, travel abroad on business visa. You could do that. Or typically what happens is large enterprises, large customers especially overseas, want to have contracts with an overseas entity. So a large US corporation will want to sign and execute a contract only with an overseas, a US-based company, so that the rules, regulations, jurisdiction in case of any disputes is the US. Also, if you're going to require a lot of visits, you can, applying for business or getting business visas is not very easy, or you want to deploy manpower in overseas jurisdictions, you may run into a lot of visa related trouble. And so it might make sense, sure, to incorporate in India, but have another entity in that jurisdiction so that your visas and your contracts get done easily. Okay. Next is a bootstrap SaaS product for B2C customers. Which kind of entity and where will you incorporate? A bootstrap SaaS product for B2C customers. Okay, somebody saying private limited where the sales are highest.
So when you say bootstrap,
OPC,
you're saying that there are no investors, and B2C customers, where are they? I mean, where location?
B2C could be anywhere. That's why I've not given you a location.
Okay.
No, I've only got a couple of answers. So we are private limited in a country where digital nomad benefits. I'm not sure I understand, but LLP, OPC, private limited in India or where the market is large, private limited in your own company. Okay, so what I would recommend over here is if you're bootstrapped and your product is already out, and you're not going to raise, if you're not going to raise funding, you need to be a private limited company. You could be an LLP. If it's a SaaS product, development happens in India. It can be used across the world digitally. You have payment gateways. Today in Stripe, you can collect money in 25 different currencies, and it gets converted and hits your Indian bank account very easily, sitting from India. You needn't register anywhere overseas. You could have one entity in India, an LLP if you want, an OPC if you want, and tie up with payment gateways, and you're good to go. Okay. Next is a customized art startup selling on online marketing places, on online marketplaces like Etsy, for example. I'm preparing customized tea posters and I'm selling them on Etsy. What do you think would be more suitable? Okay, people are saying LLP, OPC. Yes, the sole proprietorship will also do, right? A sole proprietorship will also do, because I don't see any reason for debt. Typically, these are low cost, low value products. Even if they're high value products, I'm selling paintings. It's my brand. Okay, as a painter, it's my brand. I can sell it on online marketplaces. They can do the shipping, dispatch, collect money in any currency, deduct their charges and pay to my bank account. So you needn't even actually have a sole proprietorship. You could just do it in your personal name. An entity is also not necessary, right? So that sort of brings me to the end of this section. I'm going to move on. And if you have any questions, park them for now. We'll take them up at the next Q&A round, right? Oh, sorry, I have one more, which I forgot. Do you want to take this? An AI-based medical screening software. Like one of those radiology type things.
Sorry, can I request? Okay, yeah. Any responses, please?
Yes, I've got private limited company and that's perfect. But where would you incorporate this? In India, elsewhere? Yeah. So that depends on where your investors and your largest market is. Okay. If your investors are in the US, they have issues if they have concerns related to IP infringement, or you want to tie up with the largest hospitals or large brands overseas, then you could incorporate in India or elsewhere. It doesn't matter. A private limited company makes more sense because typically these kind of companies are professionally funded companies. Okay. Okay. So I just might have one more. A D2C product startup. Anyone?
What is a D2C?
D2C is direct to customer. Let's say like Ayurvedic products. So I don't know if you guys have heard of Dr. Vaidya, for example. It's a very 100-century-old brand, and they'll dispatch Ayurvedic medicines. Somebody saying Bala will say. Or it could be cosmetics, right? So directly to customers. Yep, D2C startups if are typically debt funded, though there's a lot of investor interest right now, and a private limited company makes a lot of sense. And since you're serving customers, if they're local customers, they're Indian customers, it makes sense to incorporate in India itself. Right, so I'm going to move on to the next section, which is on equity. Okay. Now, here's the thing. Many natural inclinations about equity splits are wrong or counterproductive, and in my opinion, and are destined to cause problems in the long run, even when they seem eminently fair, wise, and peaceful in the short run. Okay? Apart from splitting, from afar, splitting equity seems like a very rational process in which each founder's value to the startup is matched to his or her equity stake. Now, equity split negotiation can be among the most emotional events in the development of a founding team. Okay, how many of you have responded or heard a response from your co-founders during this equity split discussion that this doesn't feel right? And you hear that because feelings always overwhelm rational considerations in these sort of discussions. Now, it seems unlikely that any two co-founders if would make the exact equal contribution to the value of a startup, have the exact same opportunity cost and exact same motivations. Okay, I'm sure that might be the case, but very rare. And thus it would follow logically that equal splits would not happen, right? If the equity splits are meant to reflect the founder's relative contributions and their value to the startup, equal splits would be rare or non-existent. But unfortunately, that's not the case. Research shows that 33% of founding teams split equity equally. And more often than not, this is a direct result of low negotiation pain threshold and the inability of founders to have a tension-filled discussion on such an uncomfortable topic. And so, people just take the easy way out and they say, so what? We're all in this together. Let's divide equally. If it works out, great. If it doesn't work out, all of us have lost equally. That's not what should happen. Okay. On the other hand, also avoid lopsided shareholding. See, it's important for every founder to have enough skin in the game. Remember that all of you are going to be diluted to the extent of 50 or even 60% of your shareholding by the time you get to an exit event. Right? Series C, Series D. These days you're hearing about startups reaching Series G and H. And so avoid giving too little equity to an important co-founder or having too disproportionate a shareholding. On the other hand, also don't insist that I want 51%. While 51% means a majority shareholding, but it doesn't necessarily give you the decision-making power over all aspects of business. I've seen this play out a lot in the science-based startups that I've advised. Typically, scientists will, come from this place where it's my patent, it's my technology, I understand this, and so I'm going to get 70%, and the business guy is going to get 30%. I imagine after 60 or 70% dilution, that business guy who really is the one who's going to drive that business is going to have very little stake. And many times motivation is linked to the stake in the company. And so please make sure that your equity is split in an equitable manner. Right? Just to give you an idea of what a shareholding percentage means in terms of control, here's a table which explains that. Right? If you look at less than 10% shares held by somebody, that person can only take derivative action on behalf of a company against a third party. Now, this, if I had to give you an example, I don't know how many of you remember the Satyam scam, where Ramalinga Raju basically, did all sorts of fraudulent activities. Now, if you were a shareholder holding less than 10% shares, the only thing you could have done in the case of Satyam is complain to the government against Ramalinga Raju for, for making losses to Satyam. That's it. That's all you can do. Okay, if somebody holds less than 25%, over 10%, but less than 25% shares, they can only seek protection of their rights by complaining to the MCA about the management of the company, but they cannot affect decisions of the company. For example, in the case of this whole saga playing out before the NCLT for the so-called wrongful termination of Cyrus Mistry, that whole tussle between the Tata Group and the Shapoorji Pallonji Group, and Shapoorji Pallonji Group only holds less than 20% shares, so they fall in this bracket, this minority shareholder, and that's all they can do. They can complain for relief against oppression and mismanagement. Okay. Now, if the shareholder or a bunch of shareholders together own between 25% and 50% shares, then that gives them the right to block special resolutions. Now, special resolutions under Companies Act are decisions which will impact the shareholders and their rights, or impact the share capital of the company, but not the operations. Right? For that, to impact the operations of the company, you need to hold more than 50% shares, and only then you can take decisions which require simple majority. Things like appointing directors, appointing auditors, approving dividend payment, etc. But that's basically the rights that you get. Now, if you hold more than 75% but less than 90% of the company, you have the power to do both. Take ordinary resolutions which affect the operations of the company, as well as special resolutions which affect the rights of the shareholders. Okay, so that's reasonable control. And if you're holding over 90% equity, either alone or in aggregate with somebody else, you effectively have full control of the company, because anybody who's holding less than 10% can only complain to the MCA on behalf of the company. They cannot really do very much else. Okay, so when you're deciding equity shareholding and you have concerns about control, please do keep this table in front of you before you get into the negotiation. Now, and one aspect that a lot of founders get confused about when it comes to voting is, remember that every director has one vote. This is irrespective of their shareholding in the company. You may be a co-founder with only 10% equity shares or 9% equity shares, which is like a step lower than a minority shareholders. But if you are a director on the board comprising of 2 directors, then you have half, you have 50% of the voting power. And remember, the directors decide operational matters such as hiring, expansion, policies, terms of investments, dividends, constituting ESOP, even holding a meeting for shareholders. The directors have to plan and approve it. And so, again, when you're deciding the board composition, you have to keep this in mind and decide the board in with that background. Okay. Of course, in the board, you could have things like veto decisions. You could give the chairman the right to veto any decisions. You can give the chairman a casting vote. You can give, you can ask people to abstain from voting, etc., etc. There's a lot of things that can happen in a board meeting, but the simplest way of ensuring that all co-founders have reasonable control is have a good mix and match of the directorship as well as the equity shareholding. Now, as a part of shareholding or equity decisions, the next thing that that most startups should keep in mind is founder vesting. Now, in the US, it's very easy. If you have a company, the company holds shares. They call it treasury shares. And every time the founder meets a milestone or completes a certain period of time, the company issues shares pertaining to those milestones or that tenure to the founder. So only if I'm with the company for a year and I get, I become eligible to get my share, then the company will issue shares to me. Unfortunately, in India, that's not the case. In India, shares are given upfront. You incorporate a company, you pay 1 lakh rupees, you get 100% shares. That's how it works. Shares cannot be issued before getting money or before completing. Rather, shares have to be issued on day one. Maybe rephrase that. They have to be issued on day one. And what happens is when a bunch of founders come together, only to realize later that the levels of commitment may not be aligned with the startup's needs. But the equity is already issued upfront. It is very painful to reassign shareholding. And so to deal with this situation, most startups have adopt what's called reverse vesting arrangements, which is I have 3 founders who own 33% each. All 3 of them commit to staying in the startup for 3 years, which basically entitles them to 11% shareholding per year. Then what happens is if you spend 3 years, you not only hold those 33%, but you also have earned the right to hold them. But let's say a startup founder quits after 2 years, that the startup founder has only earned the right to hold 22% of the 33% shares. But they already have 33% with them, right? So those 11% pertaining to the 3rd year, which they have not served with the startup, that 11% has to be transferred back to the existing co-founders, or it could be transferred into Esop pool, or it could be transferred to a new co-founder who's replacing this person, right, at par value, at 10 rupees or 1 rupee or whichever was the value of the share, irrespective of the actual value of the company. The company may have raised a couple of rounds of funding, might be worth crores. But if you are not with the startup, your shares have not vested, then that portion of unvested shares is sold to the Esop trust or the other founders or to a new person who's going to be replacing you at par value. This is a very effective way of ensuring that the shareholding, the ultimate resulting shareholding of all founders is commensurate with their commitment in the startup. So, and this usually, this clause is typically there in your co-founder agreement. This is not a clause that's available in the Companies Act. You cannot automatically be eligible or start doing this unless it's not mentioned in your shareholder agreement or the co-founder agreement. This is not applicable. Okay, you can't do this. There are other equity arrangements also which are commonly seen in startups, which I would like to just discuss briefly. One is the incubation stake. Now, some incubators or accelerators may ask for equity in the startup in exchange for their services, or they may also put in some money or seed capital. But equity stakes are more commonly associated with accelerators rather than incubators. Now, accelerators are sort of growth pods. They help young startups by providing them access to the right resources, mentors, networks, funding. And these are limited period programs where a group of companies are enrolled in a high-paced program and are taught years worth of learning compressed in a few weeks or months. I mean, something like AIM Prime, but I don't think venture centers taking equity, but something like that, right? Now, ideally, the goal of these programs is to help startups reach a scale-up stage very quickly so that they can be ready for a series, for a seed series or a series A round from VCs. Now, most startups usually ask for equity stake between 2 to 5%. It varies depending on the value add. They may also insist more in case they are investing funds or they're providing access to technology, or they may even take success fee if they facilitate fundraise from VCs. I've listed a few parameters over here which you can use to evaluate whether it's worth parting with equity for the value that the incubators or the accelerators will bring. Once you've decided to give the equity, ensure that it is separately indicated on your cap table. You should have a separate line on your cap table saying that I'm giving equity to this accelerator for incubation or for the acceleration program. And the reason being, sometimes when VCs or new investors come in, they might look at this very suspiciously. Why did you get equity? Did you really get 5% worth of services, etc.? It's a good idea to have that separately pointed out with an agreement and document the value add that they've done. While on the subject of documentation, also make sure that you read the terms of the incubation agreement very carefully. Please ensure that the terms do not impose unnecessary restrictions. I recently came across an agreement of a very, very well-known incubator, which for a stake of 2% wants a startup to get prior permission to raise a follow-on round. It also has a right to a board seat. Imagine, for 2%, the company cannot raise follow-on round without getting prior permission of the incubator and also giving them a board seat, which in the case of 3 directors, 2 founders, and an incubator gives them 1/3 right to voting. Right? Agreeing to such terms not only sets a wrong precedent for your next investors, it may also prove an hindrance at your VC fundraise and should be avoided at all costs. So when you're giving equity for incubation, for acceleration, do keep these things in mind. And I also know there are a lot of incubator participants, or other participants in this program who are representing incubators and accelerators. Guys, when you ask for equity from your startups, incubated startups, to give this a thought. Please don't put too many unnecessary restrictions on them. For a percentage, equity percent of 0.512, you should not tie down those startups. It doesn't make sense. Okay, the next problem, if I can call it that, is this whole advisor equity. A lot of you, I'm sure, have promised advisors, mentors, well-wishers some equity in your company, right? A common question I get around this compensating of advisors, or even sometimes also those contractors who've done some one-time development work, etc., worked on technology, made your prototype, whatever. Yeah, a lot of startups want to compensate them in the form of equity because they don't have cash. Now, please know that issuing sweat equity is very tricky. Actually, in fact, in India, a private limited company cannot issue stock options or sweat equity to consultants or advisors who are not employees of the company or not directors of the company, its subsidiary, or its holding company. You cannot do it. So the most common way of giving equity to advisors or mentors is by doing share transfer. The promoters transfer their part of their shares to the advisors. However, remember, if the company has already raised some funding earlier and has a valuation which is higher than the par value, or is a profit-making company, then the value of its shares is not par, right? It's not par value. And so under the Income Tax Act, the differential between the fair market value of the company shares and the transfer price is taxable in the hands of both you as the founder as well as the advisor. So unless you're okay bearing the tax burden, you should avoid transferring shares to promoters once the company has raised funding or once it is in a profitable stage. So what's the alternative? The alternative in such a case is to issue shares to advisors by a process called giving shares for consideration in kind. So it's sort of sweat equity, but has follows some different rules under the Companies Act. And the process of allotting shares basically involves getting a valuation report for the company, getting a valuation report for the service, and then giving a percentage of equity in proportion of the value to the company's value. Now, what happens over here is probably GST applies because this is sort of for consulting or revenue for the advisor. So he or she may charge GST. Your startup will also need to deduct TDS. And so tax-wise, again, it's not very efficient, but then it's a clean way of doing things. Slightly expensive, actually quite expensive. 2 valuation reports from a registered value, 18% GST, 10% TDS. So it is fairly expensive. But then, in this case, you can issue paid-up equity shares, fully paid-up equity shares. Another way of doing the same thing is phantom stocks. You could give phantom stocks to advisors. I will talk about phantom stocks in my next topic after this. And if you have any questions, we'll take them at that point in time. And the last thing that in equity arrangements is Esop. Esop is a very, very popular way of compensating employees. I know that Premnath has briefly touched upon this topic in one of the previous sessions, so I'm not going to talk about the benefits of Esop and why you should have Esop policies and all, but I am going to run through the mechanics of implementing an Esop and the regulations governing it. Okay. And briefly, this is how they work, right? After an employee is hired, he or she is granted options via a grant letter, where the company gives that employee the option to buy a certain number of shares within a set period of time. And after the cliff period is over, in India, the cliff period is a minimum of 12 years. This is mandated by law. After the cliff period or the vesting period is over, the options are vested, which means the company has earned the right to buy those shares pertaining to those options. And the employee can now exercise those options, which is the employee can purchase those shares at the set exercise price. Now, this price is predetermined. It can be a nominal amount like par value, or it could also be a discounted value, the fair market value. The actual benefit to the employee is only at the liquidity stage when they can sell those shares and make some money. The employee can sell shares during a secondary sale, like for example, when Walmart bought Flipkart out, all the stock options were bought out and there were millionaires, overnight millionaires in that, right? Or you could do an ESOP buyback, something like what Zerodha did a couple of months back. They valued themselves at $1 billion+ and simply bought back shares for their employees. Or when the company lists on a stock exchange like Zomato, the employees can sell their stake and get money. But again, like I said, liquidity event is very important. That's the only time when employees can that's the only mechanism by which employees can actually make money. Now, there are different types of ESOP plans. You have the plain vanilla ESOP, employee stock options. Then you have ESPS. ESPS gives basically employees the right to buy shares of the company at a lower price in the fair market value. This is very popular amongst listed companies, not so much in startups. And then there's stock appreciation rights or phantom stocks. Now, the These are not strictly stock options in the legal definition, but they're often treated as such. SARs or phantom stocks are basically cash-based incentives which are linked to the value or the price of that equity share. They grant an employee the right to get a cash equivalent of the share price gains over a pre-decided interval or period of time. The employee usually does not need to pay anything to exercise a SAR. For example, if you were to exercise stock option to buy shares, you probably need to pay a par value to the company. In the case of SAR, that doesn't happen. In stock options, the employee gets a share, but in SARs, what happens is if you want to exercise, you don't get a share, you get paid by the company as a bonus or an incentive equal to the value of those SARs units. And they are pegged to the value of the company shares. But the advantage of stock options, the advantage of SARs or phantom stocks, which a lot of startups see, is that the employee never becomes a shareholder, right? Because they don't get shares, they only get a cash bonus. And so because they never become shareholders, you don't need to give them the rights associated with shareholding. You don't have to. But the flip side of SARs is it's not a very tax efficient mechanism for employees because all the earnings that they get are in the form of bonus, and so tax at the highest bracket. However, in Esop, I could exercise my options today. I could buy shares and keep. And after 4 years, when the company gets acquired, I could sell my stock options and then I would only pay capital gains tax, right? Which is a long-term capital gains tax, which is 10%, 20% without indexation kind of things. Whereas for a cash bonus, I would have to pay 30, 33%, my highest tax bracket. So that's sort of the one flip side. But another advantage of SARs or phantom stocks is since there are no Esop-like regulations governing them, startups have the flexibility to issue SARs to employees as well as advisors or mentors. Right? Because Esop can only be given to employees or directors. There's no such restrictions in the case of phantom stocks. Moving on, and this is only applicable to stock option, the plain vanilla stock option, which is administration. An ESOP scheme can be administered by two methods. One is the trust route, where the company actually sets up a different entity. It's a private trust. It has its own PAN number. It has its own bank account. The company then issues shares to this trust. And every time an employee wants to exercise his or her options, the company doesn't give shares. The trust gives these shares to the employees. And the trustees manage the stock option scheme. But this is not very common in startups because obviously the two entities and administration costs and compliance cost increases. So most startups don't like that. Most startups use the direct route or the pool-based route where they only earmark a portion of the authorized capital for stock options, and as and when employees want to exercise the options, the company issues fresh shares to these employees. Okay. So since there's no additional entity, the cost of administration of a trust is not there, and most startups prefer this. A couple of things that most, as founders, you need to know, and these are common issues I see with many startups, is that many times founders promise stock options to their employees when the employees join, even if the stock option plan is not implemented, because the founders are either not aware of prevalent regulations or they're well-intentioned but never get around to implementing or instituting that ESOP plan. Now, one thing to remember is that there is a minimum period of 1 year after granting of options before they can vest. And you can grant options only after you have implemented the stock option plan. So let's say an employee joins in 2019 when he was promised stock options, but the company only institutes a plan in 2020 and grants that employee options in 2020. By the time the employee is able to earn those, it's 2021. right? The minimum cliff is 1 year, but the employee's already been with you 2 years. And so that becomes, a very large demotivating factor for your employees. And so if you have promised stock options to your employees, my advice would be don't delay. Implement the stock option scheme right away. And when you do so, please make sure you set aside a budget for the costs and also for the efforts involved in implementing the stock option scheme and maintaining it annually. I'll run you through the compliances in just a minute. But before we go to the compliance bit, I'd also like to run you through the different aspects that you need to think about or remember when you're implementing or designing a stock option plan. These are all the decision items, okay? And it is complex. So I'm not going to be able to talk about each of these in detail, but there's a huge amount of literature out there on the web on designing stock options, which you can go through. But this is sort of a checklist that you can use, right? The first and the first step of deciding in stock when you first decision to take when you decide to implement the stock option plan is which type of plan. I've already run you through this. There's plain vanilla Esop, there's ESPS, there's SARS or phantom options. So you decide which one you'd like. For whom would you want to implement a stock option plan? Right? Do you want to select an employee group? Let's say early employees who took the last and the most risk. Do you want the key employees, the C-level employees? Do you want it only for them? Or do you want to give stock options to everyone? Please decide that. Now, what happens is when you decide to give stock options to all employees, right? You don't tend to factor in their experience or skill or importance. And so consequently, you could be giving away a precious asset without gaining much in return. And sometimes there are employees who rather take the cash. If they rather want the cash, it's not necessary to get them, grant them options because they're not going to be a motivating factor. And you could instead give them to employees who is happy with the lower cash component and realizes and understands the value of stock options. How much to set aside in a stock option pool is driven by a couple of things. One, investors. Investors will insist on a minimum of 10% pool. That's my experience. In typical deep tech science businesses, if your key team members, the key team is not large, you just have a couple of them, then you may not need a large pool. But you could get away with a single-digit stock option pool. However, if you're a single founder, then you may even want to consider setting aside, as large a pool as 20%. It depends on your expectation of who you're going to give stock options to, how many you're going to give, at what stage you're going to give, and obviously driven by investors as well. Because remember, investors don't want to get diluted at a later stage. So before they get on board, they will push you to create as large a pool as possible. Okay. How often should you give grant options? It is very important to be practical. You can give stock options every month. They can vest every quarter, whatever, right? A monthly, quarterly frequency. But please be very practical. Managing an Esop scheme involves a fair bit of paperwork. So if you don't have an HR manager, or you don't have adequate funds to outsource stock option management, you may want to keep it simple. Annual grants, annual vesting. Recently, a host of new online tools have been launched to help startups manage Esop. Tools like Carta, Equity List, Capita, etc. You may want to check them out to gauge their suitability for your company. And if that helps you manage your grant vesting schedule, then go ahead and do it. And then you can also have lower, higher frequency for granting and vesting. When should you give stock options to the employees? When will they vest? That depends on the reason you're giving those stock options. So if you're giving stock options to retain employees, then you might want to have a higher vesting cycle. If your business is in the technology space where it takes a long time to reach the market, to get to market and sell, and have your sale, and if you are giving stock options to your R&D team, then again you might want to have a higher vesting. The standard vesting terms in most startups is 1 year cliff plus 3 years, so a total of 4 years equal vesting. But you could choose to have it front loaded, back loaded, 10, 20, 30, 40%, or whatever works for you. There are no regulations. The only thing that you need to remember is the first vesting only happens after a 1 year cliff. At what price should you give those stock options? What's the exercise price? Again, it's up to you. There is no set rule. This exercise price basically determines how much your employee will pay upfront to buy shares of your company. Industry norm is par value or nil, rupees 10 or 1 or nil. However, some growth stage startups which have raised a few rounds of funding may peg their exercise price to the last round's valuation or a discounted price to the last round's valuation. This basically ensures that the employees who join after the funding round benefit only to the extent of increase in the startup's valuation after the date of joining. If my company is already valued at 10 crores and then you've joined, then you should benefit only to the extent of taking the 10 crore to 40 crores. Right? You shouldn't get the benefit of taking from 0 to 10 crores. But, I have also seen a lot of startups not worry about that and simply give everybody shares at par. Depends on you as a founder and your motivation. Exit, very, very important, because it's exit which is going to really make money for your employees. So having an exit plan and communicating it clearly to your employees is must. Exit is how you demonstrate to your key employees the value of stock options, and that's how you convince them of the reason why they should stick around with your startup for longer duration. So I've seen founders who can narrate the story and convince the employees about their vision will be able to make most of the startup Esop plan, right? Last parting thought on Esop. It's very important aspect to remember that once an Esop scheme is implemented, once it is adopted, it cannot be modified to the detriment of the employees. You can modify it to the benefit of the employees, but not to the detriment of the employees. So let's say you can't suddenly go and impose more restrictions or put a lock-in or whatever. So whenever you're thinking of implementing an Esop plan, it is important to get these aspects right at get-go. Okay. This is the last slide on Esop, and if you have any questions, we will take it after this. Here's a quick look at the regulatory environment governing Esops. Esop regulations are stipulated by SEBI, but they're mostly applicable to listed companies. A few provisions are applicable to unlisted private limited companies, but these are watered down to reduce compliance burden. However, I advise that is good practice, and in preparation for an eventual IPO, which I hope all of you get to, it's a good idea to align your ESOP scheme with the SEBI regulations to the largest extent possible. The Companies Act also has some very stringent implementation and disclosure rules for ESOP. An ESOP plan requires approval of shareholders. ROC filings are necessary. Complete details of the ESOP, what size of the pool, how many are granted, how many have been exercised, how many are vested, what happened to unvested ones, what happened to the forfeited ones. All of that has to be disclosed in the annual director's reports, as well as the notes to accounts in your audited financial statements. It's mandatory. Granting of options beyond or more than 1% of the capital, of the rather paid up capital to a single employee requires additional shareholder approval. principles. So when it comes to implementation of the stock option plan, not only do you need to be aware and your HR manager needs to be aware, you also have to involve your company secretary and your chartered accountants at all times. If you have an overseas entity, that a parent, overseas parent, your Indian startup, your Indian subsidiary employees are eligible to stock options. They can get stock options of the overseas parent. But remember, under the FEMA regulations, any exercise or liquidity event has to be reported to RBI by the Indian subsidiary. And that has to be done within 30 days of such events happening. Otherwise, there are significant penalties for the company as well as for the employee. So please make sure that if you have such a case, you are aware of the regulations, not only in India as well as the overseas company. You have to get things such as 409A valuation done. There's something called as 83P declarations to be given to the IRS in case of vested options and vested shares. Make sure you have advisors who understand regulations of both the jurisdictions when it comes to stock options. This accounting and valuation is another major mess. Accounting for share-based payments is fairly complicated, and it entails deferring the cost of stock options over the entire vesting period. So if the value of your FM, sort of simply put, if the FMP of your stock options today or the grant date is 1,000 rupees, and I issue these to my employee at, let's say, 100 rupees, the difference between the fair value and the exercise price is 900. So that 900 rupees I have to split over the next 4 years and account for that cost over the next 4 years. But this cost of 900 has to be determined basis an option pricing report, which you have to get from a chartered accountant. And you have to do this at every grant stage and also at the year end. Okay, so it's easy if you just coincide all the grants on 31st March. So you just get one valuation report, use it for accounting as well as your tax related stuff. Okay. Also remember, under income tax rules, every time an employee exercises the options, that is, my options are vested, I actually want to buy shares, I come to the company and say, here are my 100 rupees, please give me my shares. The company has to deduct TDS on that differential of 900 rupees. That's treated as a perquisite in the hands of the employee. And so the company has to deduct TDS at the bracket applicable to that employee on the 900 rupees. You have to take that money from the employee by check or deduct it from salary and then issue shares. And this fair market value is dependent on the valuation report by a merchant bank. Okay, not by a chartered accountant, by a merchant banker, which means the company has to obtain different valuation reports from different people for different reasons. And this obviously increases the cost of maintaining the Esop plan. Non-compliance of any of these regulations invites prohibitive penalties. Therefore, it's critical for startup founders to understand these requirements before implementing the stock option plan. To sum up, Esop and various equity-based incentive structure described by me earlier are very, very attractive to motivate, incentivize, retain employees, but in finalizing the Esop structure best suited for your specific needs and for the commercial objectives of your startup, the interests of all stakeholders must be weighed against each type of stock option plan, the structure, the benefits, right? And the key determinant factors of designing the structure should be primarily driven by value creation for employee. One. Second, how tax efficient it is. And third, ease of administration. Believe me, even if you have the best interest at heart, if your ESOP plan is not easy to administer, it is going to fail. Right? At this point, if you have any questions, we will take them. I'm not aware of what time it is and how much time I have. I have another section to run through. So, and I have a bunch of a few case study type questions. So
Sujata, it is about 6:33 right now.
So I only have half an hour, right?
Yeah, and I don't know how much time you need. So how much time do you
I
need?
need a little over half an hour.
Okay, so let's take 5 minutes of questions. Okay. Any questions anybody has? Some I think you have answered. Can the ESOP be vested at par value? Yes, but it has consequences, right? Case that somebody, I mean, here a startup raises money at 10 crore valuation. Now, an incubator advisor needs to be given 2% stake. What price do they pay for the equity, face value or par value?
They can pay face value, par value, fair market value, whatever you guys want. It's an arrangement between you. But remember, any differential between the fair market value on the date of transfer and the price they pay is taxable. It is taxable in the hands of the startup incubator, and it has to be supported by a valuation report.
Yeah. So if you want to avoid that, then they have to pay at the fair market value, right?
Yes.
And if alternatively, you issue the shares well before the investor comes.
Well before an investor comes in. There is another option, which is share warrants or phantom stocks, but I'm not sure if I have never in my experience come across a startup incubator who's willing to accept phantom stock options. That would also be an easy way, because at the end of the day, they're only concerned about the monetary reward of incubating a startup at an exit event, right? But that way, they remember when you give phantom stocks, you don't, that incubator doesn't get onto the cap table of the company. It's just a contractual arrangement.
Yeah. Okay. So any other questions that people want to pose from ESOP section? Otherwise, I'll go to the previous few points also. But anyway, let's just see. We have only a few minutes. How much does it cost to get valuation for sweat equity?
Sweat equity, like I said, you have to get two valuation reports. They have to be from a registered valuer. You have to value the effort of the advisor or whoever you're giving equity to, and you also have to value the company. The cost can range anywhere between 50,000 rupees to a lakh, depends on which registered value.
Sujata, if anybody who does say a simplest possible ESOP plan should budget what kind of costs per year once they get into it, and that also will depend upon of course, the level of investment that people are coming in with, right?
Yes.
So
yes,
can you tell us roughly
so
how much
in the first year for designing, implementing and maintaining the stock option plan, anywhere between a lakh or lakh and a half, and on a recurring basis, depending on the complexity and the number of grants, anywhere between 40,000 to a lakh a year.
Yeah. So if
again, broad numbers, I will not be held to them.
Yeah.
No, for them.
No, I understand. That's perfectly fine. The message here is that unless there is a sizable investment coming in from an investor, it doesn't make sense going into very complicated arrangements. You should keep it simple, right?
Keep it simple.
And if once the investment comes in and the investor insists on it, it's a good idea to initiate some of those things as well.
An investor will insist that you have a stock option plan, because they will not want to be diluted once they are on the cap table.
Yes, and if I just wanted to go one step back, Sujata, last question, then you can continue. What happens when founders or somebody refuses to sell back the shares in reverse vesting agreements? How is that dealt with? Is it something that you see quite a bit?
That's a very interesting question, and yes, that's possible. I have seen it happen. So there's nothing you can stop. I mean, you can't really predict if a founder says, no, I'm not going to sell my shares. What will you do, right? You can't really stop that sort of situation. But yes, what the startup can do is make sure there's a co-founder agreement that is properly executed on a stamp paper, signed by everyone, approved by the board. The terms of the co-founder agreement should be incorporated in the articles of the company so that the company is also bound by it. Then document why the co-founder has not owned those shares in a board meeting, in formal communication to the co-founder. Very important to do that. And if after all of this, the co-founder refuses to transfer his or share back after having agreed to the terms of the agreement, that becomes a breach of contract. So you could, depending on the terms of the agreement, either go for arbitration or you can sue the co-founder. That's a difficult thing to do. Lately, I have started in my in startups that I advise, I have started a new process where along with the co-founder agreement, I also get them to execute share transfer forms and a power of authority, attorney. And that power of attorney basically says that the board has the authority, if it determines, to use those pre-signed share transfer forms to transfer shares to whoever they may choose. But I mean, not all co-founders agree to that. But yeah, that's one way of doing it.
I think let's continue, Sujata. We'll come back. Yeah.
So the next, so just a couple of things. Just to see if people have got the gist of ESOP. Can you tell me, for a medtech startup with 4 founders, what, in your opinion, which kind of stock option plan would be ideal? ESOP, ESPS, or phantom stocks? And how much percentage would you set aside? Okay, somebody says SARS for 10%. Anyone else has an opinion on this?
ESOP
10%, ESOP 8 to 10%, ESOP 25%. Very, very generous. See, if you already go for 4 co-founders, that means you have a key team in place, which means you're really going to give stock options to your early or very, very key employees. Okay, you may not need a large pool, and you could do SARS or you could do ESOP. 5%, 7% is ideal, but 10% is the upper end. 25% is unheard of. A consulting company with 10 employees. Okay, somebody said ESOP 20%, SARS 10%. It would be great if you could also just jot down in a couple of words why you're saying that. People are saying ESOP only to a select few, ESOP 15%, ESOP 15 to 20%, 10%. Right. So here's the thing. Why do you give stock options? You're giving stock options so that employees can make some money at exit. Right? It's a consulting company. What exit are you going to have? Small consulting companies with 10 employees is not going to be VC or investor funded. At the most, it may get acquired at some point in time, but in a consulting company which is highly profitable, usually can afford to pay market salaries, does not need stock options at all. Okay, so you may want to not have a stock option plan at all. Okay, a contract research company owned by an overseas holding company. So IP is in the overseas entity, and they have a subsidiary in India where the employees are doing contract research or developing that same IP. Any thoughts? Direct equity to early employees, somebody saying? No ESOP. ESPS. Okay, here's the deal. If it's an overseas entity with IP held in the overseas jurisdiction, it's most likely investor funded. So it has adequate amount of money to pay market salaries and may not want to give stock options at all. Or if it does, it may want to give stock options of the overseas company to a few key Indian company employees, like the C-level people. And so it might have, it's okay to have a small pool. According to FEMA regulations, since you have to do a lot of reporting to RBI for exercise and at liquidity event, it makes sense to have a plain vanilla ESOP plan here. Okay, an LLP in low-cost healthcare devices space with a single founder. Any thoughts over here? Yes, at requesting LLPs cannot have Esops. So that's right. This is the last one. If you want to create an additional ESOP pool in a biotech company which has already raised VC funding, already has an ESOP trust. Okay, so it's a biotech company which is funded by a VC, has ESOP trust, but wants to create additional stock option pool. Slightly complicated scenario, but does anybody want to take a shot at this? SARS. And how much equity? What percentage would you want?
You mean in the pool, right? New pool.
Yes, in the new. So people are saying lower single digit and mostly SARS. See, here's the thing. SARS is an excellent choice because you already have an ESOP trust with plain vanilla ESOP, right? So the company can then pick and choose if they have a SAR or a phantom option pool, depending on the kind of employees they're giving those options to. So SARS, yes, definitely makes sense. And again, you have an ESOP trust. So there's already some bit of ESOP over there. And the pool size should really depend on why you're creating it. Have the stock options in the trust already been exhausted and creating a new pool? Or are you just creating a top-up pool because a new VC has invested, in which case it can be single lower digit? It also depends on whether the earlier how many employees do you have in a typical biotech startup? You may not have a lot of key employees, so you may not need a very large pool. So SARS with a lower single digit pool might be a good enough. Okay, so that brings me to my next topic, which is financial management of startups. This is a topic I love. It's like close to my heart, okay, because I help a lot of startups manage their finance, which also means that I had a lot to say about it, but I'm not going to because I don't have a lot of time over here. And so I have some 5-6 slides, but maybe I'll run through just a couple of them. Okay, the bottom line is this. Building a successful startup is just more than just creating a product or attracting investors, right? Though you see a lot of times in all these WhatsApp groups, I've got a patent and everybody starts congratulations, or I've raised 1 crore and everybody starts congratulating as if it's sort of a big success. Sure, it is, but at the end of the day, a startup is not just about getting a patent or attracting investors, right? At the end of the day, you want to make money. And so research shows that startups who are financially savvy entrepreneurs are more competitive, they're more resilient. And it's essential for startup founders to know about the financial nuts and bolts of running a startup, like things like financial models, taxation, compliance, capital management. All of this impact the valuation for startup and also its longevity. Now, I know that Prernath is going to run you through the evolution of financial statements and it's going to talk about financial simulations. So I'm not going to get into those details. Instead, in this topic, I would like to briefly touch upon a few tools which you can use to manage or monitor the financial health of your startup. Just quickly, a few good practices to follow, especially if there are any new startups or aspiring entrepreneurs in this cohort. First and foremost, incorporate early. That way you can start recording your business expenditure correctly and in a timely manner. Also remember to keep your personal and your business transactions separate. In the eyes of law, you and your startup are two different entities. Okay? Learn about various regulations and compliances applicable to startups. These can be taxes, labor law, business registrations. Non-compliance is very expensive and misouts will seriously hamper your startup's ability to raise the investment funding. Keep a meticulous track of financial transactions. Just set up simple spreadsheets, create a simple filing system for your documents. Because if it's not done early on, it can be very overwhelming towards the end of the year when your auditor will ask you, what is this 415 rupees on 5th of April? And you're like, I don't know. Okay. So, that gets very painful. You can definitely use online tools like QuickBooks and Zoho Books, but just one caution here that most accountants and auditors are not very fond of these new age tools. So they might want to insist, they might want to do accounting again in traditional softwares like Tally. So don't sort of insist or expect them to automatically work on the tools that you find easy to use. These are the few tools that I like my startup founders to use in financial management of their companies. Do remember, see, accounting is not the same as financial management. Financial management is about analyzing the numbers and making decisions on how to run a business, right? How long will it take to get a customer to buy a product? How much do we spend on marketing to generate targeted revenues? How much cash do you need to reach a certain milestone? These are the questions that investors are going to ask you, which you should be asking yourself. And using these tools will help you get answers to those questions and also help you keep a tight leash on the finances of your startup. They will also tell you what has happened, what is happening, and what is expected to happen in a startup before it actually occurs, before those scenarios actually occur. Prernath, just a quick question: are you going to run them through the balance sheet and the P&L?
Not in great detail. I will only use it to the extent needed to show where the money goes, right, in the beginning. But I think you should continue with this. You should talk about it, please.
Okay. So the first tool is the balance sheet. You can actually use the balance sheet in managing the finances of your startup, right? And I'll tell you how you can do that. What is the balance sheet? It's basically the balance sheet of companies' a statement. It tells you what the business owns and what it owes at a point in time. It's like a snapshot, a photograph. And it changes from every second to second. And while the balance sheet does not provide ready answers to you, it helps you in analyzing figures and ratios and numbers. And it might be quite revealing about how you're managing the business. But before we get on to the analysis of the balance sheet, let me quickly explain how to read it. Right? When you start your company, you basically bring in your savings and maybe savings of your families and friends in the form of equity capital, right? You then deploy and you may also get some money from friends and family in form of interest-bearing debt, loans, or some secured, unsecured loans for your banks. And this is the funds these are the funds you've sourced for your business. Now you can deploy these funds. The first thing you will do is you will go and buy fixed assets and capex, right? Which to set up the infrastructure of your company. You will invest in machinery, in furniture, office, computers, technology, licenses, etc. Now remember, by themselves, the fixed assets are not going to produce any goods or any services, any products. products. For that, you need working capital. And what is working capital? Working capital is basically that money, this money, which you're going to pay to your suppliers to get raw material, which you will convert into fixed goods or products, which you will sell to your customer. The customer will buy it and pay you back in cash. Now, hopefully, your customer will pay you a little more than it took for you to manufacture those products. Right? And that little more, that incremental amount is called your profit, which goes and sits in the share capital. Now, what do you do with the profit? First, the government gets a pound of flesh in the form of taxes. So you pay taxes to the government. The next, you'll take a small portion and you'll put it back. You'll put it back in your business. You reinvest it in your business for business growth or expansion. So you'll buy more computers and more tables and more machinery so that you can manufacture more, right? And some part of it you might use to pay interest, give it to your lenders, or you may choose to repay your borrowings, pay your installments or your term loans out here. And then at the end of it, if anything is remaining, you will give that to your shareholders in the form of dividends. Okay, but that's very rare in startups, giving dividends to your shareholders. Now, this is the case of a manufacturing company. What if yours is a services startup? In that case, you will not have suppliers and you will not have raw material, but you will have employees and you will pay rent and you will pay salaries. And it's your employees who will provide services to your customers, who will then pay for the services, and hopefully they will pay you a little more than it costs you to provide those services, which is again called your profit, and then it goes back to the profit pool called the reserves and surplus, and then you will deploy it again in expansion, repaying debt and giving it to shareholders. So that's how a balance sheet works, and that's how you should basically look at your balance sheet and read it. Now, this cycle of converting cash into product or services and then back into cash is called the working capital or the cash cycle. And needless to say, the faster you run that working capital cycle, the more profit you generate. So it's very essential to have a very tightly run working capital. Effectively managed businesses have short working capitals. Okay, they have either very lean teams, so you pay less salaries, or they have great stock control. They will order just in time. They will convert them into goods quickly. They will sell them. They will have very strong forecasting of sales and demand. They will also make sure that the terms that your suppliers and your creditors have aligned with each other. So if your customer says, I want a credit period of 60 days, you will go to your vendor and you will tell your vendor, I'm going to need 60 days credit from you. Because if your customer gives you money in 60 days and you have 30-day terms with your vendors, then you're going to have to put that profit, the money of your profit, not over here in this reserves and surplus, but you're going to have to invest it in giving it to your vendors. So effectively managed businesses also are very good at balancing their debtors and creditors, and they usually have back-to-back terms, payment terms with them. Now, when you put these four aspects, equity, fixed assets, debt, and working capital, you put them together, you see the entire picture of your balance sheet. Remember, because accountants like us do accounting on historic cost basis, on purchase cost basis, your balance sheet doesn't necessarily reflect or indicate the market value of your business. Okay, but the balance sheet does help you decide on the financial structure, and it helps you take better decisions. Okay, how? By these ratios, the shareholder earnings ratio, debt equity ratio, solvency ratios, efficiency ratios such as working capital turnover, fixed capital turnover. You have quick ratios, you have current ratios. These are different ratios which you can easily read up online, and you get an idea of how to use those ratios. Basically, investors, bankers closely monitor these ratios. They gauge the ability of the startup to earn money and to repay debts. Acquirers might look at your working capital to see how quickly you generate profit. And so, therefore, it's very important for startup founders to learn about these different financial numbers, how they're connected to one another, and also to make sure that the ratios for their startups are better or in line with similar businesses in the industry. The second part of a financial statement is the P&L. P&L is basically a profitability or profit and loss statement where you have these components. You have revenue or sales. You reduce the cost of goods sold or cost of services sold, which is basically all the cost incurred to produce those goods or services. And the resulting profit is called the gross profit or the GP. Why is GP important? The GP is important because health helps you arrive at the break even. What is break even? Break even is the point of revenue or the sales where your business is at a no profit or no loss, where you've recovered all the costs of making, selling, and running the business. Okay, no profit, no loss. Now, if a balance sheet is a snapshot, the P&L is like a video. It's a movie. It tells you the story of how over time, over a month, over a year, the activities that you did in your business have all come together to either generate profit or losses. As a startup founder, you need to understand a few key scenarios. One is the GP margin, which is basically the difference between the cost of sales and the revenues. Investors love when you have large gross profit margins. That gives them the comfort that your business is strong. A higher GP margin also gives you a more wiggle room to take risks, to give discounts, to invest that excess money in R&D. It might also mean that your customers are willing to pay you a higher price to use the product or your service. It's very useful to them and they don't mind paying a higher amount. Next is the operating expense or the OPEX. Now this OPEX, most accountants will club it together. Whatever is not COGS is overheads. But as founders, you might want to split them into two different kinds of expenses. One is operating expenses, which includes things like your engineering costs, your R&D costs, your sales and marketing expenses. These are essential and that really depend on the stage of your business, right? Don't lump them into the administrative costs, which the accountants usually do. Administrative costs are things like rent, electricity, telephone, your accounting costs, your auditing costs. These are more or less fixed, and they will be incurred irrespective of the size of your business or the stage of your business. Good entrepreneurs keep these expenses to the minimal possible and use the saving in these expenses to grow business. Either they use it to generate more goods or they use it to generate more products in the pipeline by investing in R&D, by getting a bigger engineering team or whatever. So managing these expenses, knowing these percentages is very essential. You can also benchmark them to other companies of the same kind and see where you stand. Keeping a track of these expenses, segregating them also gives you an understanding of your cost structure, which will then in turn help you in setting prices of your products. Other than this, you need to know the EBITDA. EBITDA is the earnings before interest, depreciation, tax, and amortization. And the EBITDA helps founders compare different companies and remove impact of the size of the company, the funding type of the company, the age of the company. So if you wanted to compare a small software services company to Infosys, okay, you can compare EBITDA because you're removing the effect of your capital. You're removing the effect of the size after you remove the depreciation. You can remove the effect of the investment in assets by removing the depreciation and amortization. And you can also remove the effect of tax planning. The larger companies are better in terms of tax planning by removing the tax component. So EBITDA is usually comparable across companies, but typically PAT or retained earnings, PBT are not. Okay. The second tool is unit economics, but I don't have time for this, so I'm just going to run through it and I'm going to skip this. Okay. This is the last thing that I'm going to talk about, and which is cash flow and cash burn. Okay. This is, in my opinion, the most important of the tools. Cash is the lifeblood of a business. It decides how long your business is going to survive. See, by itself, cash does not generate income. It's not a productive asset. Therefore, the cash on the balance sheet should be relatively small. It should be invested mostly in assets, but you should also have access to enough cash as and when it's required. So there should be, a source and some sort of commitment of that cash. It's, in my opinion, it's very important for entrepreneurs to track cash on a weekly basis, which basically means tracking inflows and outflows diligently. Let's say you have 10 lakhs in your company's account. Then buying a laptop costing 1 lakh rupees seriously dents your cash balance, right? But renting it for 5,000 rupees a month makes that same 1 lakh rupees last you for 2 years. So sure, it might cost you more to rent, but if it extends the runway of your business, then you might take the counterintuitive decision of actually renting it as against buying it. See, in early stage startups, extending the runway is very critical. Most startups don't die because they didn't have a great product or they didn't have a great team. They simply die because they ran out of cash. And that's why you need to understand the working capital cycle and how to run it quickly, and also identify ways of quickening that working capital cycle and sweating your assets as much as possible. And the concept that a lot of founders need to understand is a cash break even. It's a concept similar to profit or cost break even. Cash break even simply tells you at which point your business starts becoming cash positive. Like in the case of an IT services company, a single founder an IT services company, you buy a laptop, you buy some software subscription, you buy an internet connection, you develop a project for a customer, you sell it, you get your money back within 2 months. And so you become cash positive in under 2 months. But in the case of a biotech or a pharma setup, this might run into 5 or even 10 years. And that basically means that your cash break even is going to extend. And the longer it extends, the riskier the the business. So just have an idea of when your when your business or startup is going to turn cash positive, because that's also the point where you're going to stop needing investment or external funding. Then at that point in time, the startup or the company is sustainable, based on the internal cash revenues itself. Startups should monitor the cash burn. The difference between the outflows and the inflows in a period of time is called the burn rate. And dividing your cash balance with this burn rate will give you the runway. The runway is how long your business will last until it runs out of money. See, high burn rates by themselves are not worrisome. High burn rates are worrisome when you scale the business up and the model just does not look any better. Burn rates are also scary when the runway is short. Like you're burning 20 lakh rupees a month when the balance in your account is 3 crores, that's fine, right? You have a runway of 15 months. But when you're burning 50 lakh rupees a month with only 2 crores in the bank account, it's not going to take you far. It's going to last for 4 months. So it's very critical to keep a track of this metric very closely. Now, remember, typically funding agencies and VCs will push you to spend that money very fast. And sometimes this leads to faster growth, but more often it leads to empty bank accounts. Remember, VCs and grant funding agencies are incentivized by the quantum of funds they deploy. They also want to focus on startups which are winners. So if yours is going to fail, they prefer that it does that faster, so that they can focus on the startups which have a better shot at success. And also in grant funded companies, you first have to prove that your previous installment was completely utilized, and then they will give you the next round, right? So VCs and grant funding agencies want you to finish that money quickly, but the startup's incentive is different from that for funders. You want to stay in the game longer, and for that you want to spend cautiously. You want to decide how you're going to spend the money, because a penny earned is a penny saved, right? You want to be frugal. You want to spend money like it's your own money, not an investor's money. You might also want to spend like you're not going to, you're not having, you don't have visibility, you're not going to raise any more money, because squeezing every drop from every rupee available to you will help you stay in the game longer. And when you're staying in the game longer, you have a better shot of making a success of your startup. Right. So if there's anything that you take away from my session today, is that please keep a track of your burn and your runway, and continuously think of how you're going to extend your runway. I have a couple of other slides, but we don't have time. So I'm going to wrap it up right now. In closing, I just like to say that I hope that the tools I've discussed with you today will help you, help you manage the business, because entrepreneurship is filled with uncertainty, and the environment is constantly changing. And this scenario, you need every tool you can use to steer your startup towards success. So looking down the road at where your financial condition is headed helps you avoid major problems. Startups which plan their entity structure well, ensure optimum distribution of equity, and do sound financial management have a better shot of success than startups which fail to anticipate and plan for them right from the beginning. That's all I have for now. Thank you for listening to me patiently. I wish you all the best, and hope that the session will help you see finance not as a dark art, but as a powerful tool to help you build a successful company. You can stay in touch with me by following me on Twitter, or in case you wish to reach out for advice, feel free to drop me email. That's my email ID. If you have any questions, and if we have time, we can take them now. I leave that to Prema to decide.
Yeah. Sujata, you will be again speaking on 23rd, but the topic is very different. So we will be seeing you again. The two slides you missed, I think they are quite important. But the unit operations and the budget and forecasting is also one more thing is if there is a way by which you can suggest any example available somewhere of how budgeting is done, right, or well done, or how unit economics, some article written up or something that will be helpful. Okay, can I request you to briefly touch at least upon unit economics and that, so that people can at least read up a little bit, because I don't want to miss that out.
Okay,
we can take maybe about another 5-10 minutes. Yeah.
Okay, so unit economics, right? Very, very important. Now, you may come across all these different startups, especially the online e-commerce companies, where they're doing heavy discounting of their products, and you keep wondering, okay, how can they even afford this, right? Or you go to a customer, and yours is a new startup, and your customers asking you for impossible prices. Okay, understanding unit economics will help you in these scenarios. It's very critical, and it will help you just go beyond just the sales or the absolute expense numbers. Now, unit economics is sort of the filter that evaluates a business for profitability at a unit transaction level. It looks at your business model from the perspective of a single customer or a single order. Before you start selling, it's very important to calculate your unit economics, right? How much revenue, how much gross margin, And even if it's possible, how much net profit are you going to make on a single order? It's very important to know. Why? Because selling at a loss or worse, even at a negative gross margin, is not a good idea. It should be avoided. I mean, growth on the back of an unprofitable product will always result in loss, right? It's an expensive mistake if your startup is funded. A lot of funded startups do that. They sell below the cost price of the product. In a few strategic places you could. For example, when I was working at First Cry, people who have babies or very, very young children will know that diapers are extremely expensive, but they are an essential commodity if you have a baby. And so for a lot of the e-commerce companies and even First Cry, even now, you see that they sell diapers at 30-40% discount on MRP. How can they do that? They do that because diapers are considered to be a loss leader. They're called a loss leader. And the startup is willing to bear a loss on the gross margin. They are selling at a price less than the cost price of buying them, simply because they treat that not as a revenue. They're treating the diaper sale as a marketing gimmick. They want to onboard as many customers as possible in the hope that when customer comes to buy diapers, they will also buy toys and books and clothes and other accessories which have very high margins. And on an overall basis, then the company will not have, will sort of make up for that loss on revenues for diapers. So those kind of products are called loss leaders. But that's okay if you're a funded startup and you have multiple products which have different margins. Okay. But if yours is a one pony horse, you have one product, then and you underprice your product, or worse, if yours is a product where you have very low margins, but you're giving services, or if you require onboarding and implementation and migration, etc., and that onboarding is given for free or it's given away at below the cost, then the lack of unit profit just causes a downward spiral. It's very difficult to get out of it, because one is setting a precedent where your customer is now expecting you to waive off those charges, while they used to a discount where in the next year when you go for renewal or you want to resell the product, they already used to a lower price. It's very difficult to get rid of it. So if you're tempted to onboard a customer at very, very low prices, or worse, at prices lower than the cost of production, please avoid doing that. Okay. Now, sometimes it also happens because as a founder, you're just not aware about unit economics. You don't know what's the fixed cost of your product, of your business. You don't know what's the variable cost of making that product or delivering that service. And so you come up with this weird pricing, which is benchmarked either on your competitors' pricing, or you just take it off from the top of your mind and you go and quote it, or it's depending on your customer's ability to pay. Now, what happens over there is then your pricing is not dependent on the cost structure of your business. It's dependent on external factors. Now, when you go and defend these numbers to an investor, remember, investors are very smart. They have seen many companies. So an investor can quickly determine when the founder is trying to defend revenue models which are not thought through. And trust me, it does not take more than a few questions to unravel those woven threads in your story. So zero in on more profitable customers. How can you do that? If you have multiple products, please figure out which is the highest, product, in which product you have the highest margin. Try and sell that, or bundle your product such that lower margin for a product sort of makes up by higher margins on service. Like, for example, I have a client who provides embedded electronic devices which uses GPS to track vehicles. And so they just give the product for free. But they make sure that there's a subscription model for the next 3 years where the customer is tied in and that subscription is taken up front. And the services are basically at zero cost because the platform is built and they don't spend any more money. And so giving away the product for free but also taking subscription amount from for 3 years makes them good as far as the gross margins are concerned. So figure out that product mix early in a startup's life. It can make a difference between a business that thrives and a business that does not work. I've also seen companies which raise a lot of money at a particular risk. Trust me, there's nothing more tempting than trying to solve a problem in a business by throwing more money instead of fixing that product or service. If your customers are not willing to pay you above a certain price, there is a problem, structural problem in your cost structure. So please figure out what it is that you're doing wrong. In there, don't try and give more discounts, or don't try and make more, build more features into the product. No, please fix the product first and make sure that it fits within the cost structure that the customer is willing to pay for. Bulk ordering, another pitfall I see a lot of startups doing. I'm going to import from China. I'm going to import certain electronics from China because they're very cheap over there. Problem with importing from China is you have to do it in bulk. But for an electronic devices, a healthcare devices company, importing in bulk does not make sense because your technology is evolving. And what if you import in bulk and those things don't work? Then it's a waste of all the equipment and the consumables and the components you bought. So until and unless your technology is set, you're sure about it working and you're sure that your customers are going to buy it, please don't order in bulk. You're just going to spend a lot of money in trying to take benefit of a discounted bulk price. You're just going to spend a lot of money. Also make sure that in case your business is such that the cost of producing providing a service is dependent on a third party, like one of these fintech companies that I advised a few years back, which unfortunately folded. They were in the area of providing microcredit services to gig economy operators like your Swiggy boys, delivery boys, and your Uber cab drivers. And so this was a technology company. They would borrow from an NBFC, issue these cards to the drivers and the delivery guys, and take some money back from them, some fees back from them, and return the NBFC. Return the NBFC their borrowed amounts. Suddenly, overnight, regulations changed. The NBFC had to increase their interest rate multifolds, and obviously the startup couldn't pass it on to the gig economy operators. And basically, the overnight change in the cost structure was so huge that the only option they had was to shut down. They could not sustain negative margins. They tried doing it until the time they had VC funding. Once that funding dried up, obviously, you can't go sell something for a price lower than what you bought it at on a sustainable basis. So they shut down. So, make sure that you have back-to-back arrangements. Mindless growth without with poor unit economics is a true recipe for disaster. Okay, so understand your unit economics. Understand what is the cost of providing the service or the product. Make sure that when you sell it at a price which is higher than the cost of producing that service. There are various different components like fixed cost, variable costs, semi-variable costs. Very easy to understand. You could go and read up on the web, and I can also give some material, reading material. I can suggest some of it so that you can buy yourselves.
Sure. Thank you, Sujata. I think that covers a lot of ground. What I will do is, since it's already 7:22, we will close now. Thank you so much. This was a very useful talk and very useful for all the participants. I'll now hand it over to Mugdha so that she can announce her administrative announcements. And we will see you again on when is it? Next is 23rd.
Monday. On the coming Monday. Yes.
Okay, great. Okay. Yeah. Thank you so much. Thanks, Sujata. Thanks a lot.
Thank you.
From all of us. Yeah. Thank you.
Thank you, Sujata, for spending your time with us. So over to some announcements now. The feedback link is in the chat box already. Please use it and give your feedback. Another is a gentle reminder about the submission coming up on 20th of August for your pitch storyline. Please do discuss these storylines within your project teams before you submit them on the Google Classroom. If you submit it in time, then you will be given a mentoring session with Dr. Premnath in the week of 23rd August. So this was the announcement, and let us meet all of you on in the next session on Wednesday on Indian Landscape Funding Facilities and Capabilities by Shoma Chattopadhyay. So goodbye, everyone.
Thanks.